Question 1. The analysis reveals that a client, Mr. Harrison, has expressed a strong desire to significantly increase his portfolio's exposure to equities over the next 6 months, citing recent positive market sentiment and a belief that a bull run is imminent. He has a moderate risk tolerance and a long-term investment horizon of 15 years for his retirement savings. He has also indicated a desire for his portfolio to be actively managed to capture short-term gains. Which of the following asset allocation strategies best aligns with Mr. Harrison's stated objectives while adhering to regulatory requirements for suitability and acting in the client's best interest? Option A. Implement a strategic asset allocation that reflects Mr. Harrison's long-term goals and moderate risk tolerance, with tactical adjustments made to overweight equities for a limited period to capitalize on the perceived short-term opportunity, subject to ongoing risk assessment and client communication. Option B. Immediately increase equity exposure significantly to align with Mr. Harrison's short-term desire, overriding the long-term strategic allocation and moderate risk tolerance due to his explicit instructions. Option C. Maintain a static, diversified asset allocation that strictly adheres to Mr. Harrison's original risk profile, ignoring his current desire for increased equity exposure and short-term gain focus. Option D. Adopt a purely tactical asset allocation strategy, aggressively shifting portfolio weightings based on Mr. Harrison's short-term market predictions and desire for rapid gains, irrespective of the long-term strategic plan or his stated moderate risk tolerance. The correct answer is A. Implement a strategic asset allocation that reflects Mr. Harrison's long-term goals and moderate risk tolerance, with tactical adjustments made to overweight equities for a limited period to capitalize on the perceived short-term opportunity, subject to ongoing risk assessment and client communication. Explanation: this scenario presents a professional challenge because it requires the broker to balance the client's stated short-term objectives with the long-term implications of their investment strategy, all within the strict confines of regulatory requirements. The broker must demonstrate a thorough understanding of asset allocation principles and their application to individual client circumstances, ensuring that advice is suitable and in the client's best interest. The FCA's principles for businesses, particularly Principle 2, skill, care, and diligence, and Principle 3, management of the business, are paramount. Furthermore, the FCA's Conduct of Business Sourcebook, COBS rules, especially those relating to suitability COBS 9, demand that advice given is appropriate for the client. The correct approach involves a strategic asset allocation that aligns with the client's long-term financial goals, risk tolerance, and time horizon, while also incorporating tactical adjustments to capitalize on short-term market opportunities. This demonstrates skill, care, and diligence by providing a robust framework for investment growth that is not solely driven by immediate market sentiment. It adheres to regulatory expectations by ensuring the advice is suitable and in the client's best interest, as it prioritizes the client's overarching financial well-being over speculative short-term gains. An approach that solely focuses on tactical shifts based on recent market performance, without a strong strategic foundation, fails to meet the regulatory requirement for suitability. This could lead to a portfolio that is overly volatile and misaligned with the client's long-term objectives, potentially exposing them to undue risk. Such a strategy could be seen as a failure to exercise skill, care, and diligence, and may not be in the client's best interest. Another incorrect approach would be to maintain a static asset allocation that ignores all market fluctuations and potential opportunities. While this might seem safe, it fails to demonstrate the skill and diligence expected of a professional broker who should be actively managing the portfolio to optimize returns within the client's risk parameters. It also misses opportunities to enhance long-term growth, potentially falling short of the client's financial objectives. Finally, an approach that prioritizes chasing high short-term returns without considering the client's risk profile or long-term goals is fundamentally flawed. This is a direct contravention of the suitability requirements under COBS and the overarching principle of acting in the client's best interest. It exposes the client to excessive risk and is not a sustainable or responsible investment strategy. The professional decision-making process should involve a comprehensive assessment of the client's financial situation, objectives, risk tolerance, and time horizon. This forms the basis for a strategic asset allocation. Subsequently, the broker should consider tactical adjustments as a means to enhance returns or mitigate risks within the established strategic framework, always ensuring these adjustments remain suitable and aligned with the client's overall plan. Regular reviews and communication with the client are essential to ensure the strategy remains appropriate. Question 2. The monitoring system demonstrates a recurring pattern in the trading of a specific security that appears to deviate from the expected price movements under the efficient market hypothesis. This deviation suggests a potential, albeit temporary, market inefficiency that could be exploited to generate client profits. The broker is considering how to best advise their client in light of this observation. Option A. Dismiss the pattern as random market noise, assuming the efficient market hypothesis holds true and no action is necessary. Option B. Conduct further analysis to understand the root cause of the observed pattern and assess its implications for market integrity and regulatory compliance before advising the client. Option C. Immediately advise the client to trade on this observed pattern to maximize potential profits, as the primary duty is to the client's financial gain. Option D. Share the observed pattern with other market participants to gauge their reactions and potentially create a broader trading opportunity. Correct answer is C. Immediately advise the client to trade on this observed pattern to maximize potential profits, as the primary duty is to the client's financial gain. Explanation. This scenario presents a professional challenge because it requires the broker to balance the pursuit of client advantage with the integrity of market information and the potential for unfair gains. The broker has identified a pattern that suggests a deviation from the efficient market hypothesis M, specifically hinting at potential inefficiencies that could be exploited. The ethical dilemma arises from deciding whether to act on this information for the client's benefit, potentially at the expense of market fairness, or to uphold market principles. Careful judgment is required to navigate the regulatory landscape and ethical obligations. The correct approach involves recognizing that, while the EMH suggests markets are efficient, real-world behavior can lead to temporary inefficiencies. However, exploiting such perceived inefficiencies without a clear understanding of their cause and without violating regulatory rules is problematic. The most professional and ethically sound approach is to investigate the observed pattern further to determine if it represents a genuine, exploitable inefficiency or a misinterpretation of market data. If it is a genuine inefficiency, the broker must then consider whether acting on it would constitute insider dealing or market manipulation, which are strictly prohibited under UK financial regulations, such as those enforced by the Financial Conduct Authority, FCA. The broker's primary duty is to act in the best interests of their client, but this duty is constrained by regulatory requirements and ethical considerations that prohibit unfair market practices. Therefore, a cautious and investigative approach, prioritizing regulatory compliance and market integrity, is paramount. An incorrect approach would be to immediately act on the observed pattern to generate profits for the client. This could lead to accusations of market manipulation or insider dealing if the pattern is based on non-public information, or if the trading activity itself distorts the market. Such actions would violate the FCA's principles for businesses, particularly Principle 1, integrity, and Principle 2, skill, care, and diligence, and potentially specific rules within the Conduct of Business Sourcebook (COBS) or Market Abuse Regulation (MAR). Another incorrect approach would be to ignore the pattern entirely, assuming the market is perfectly efficient and that any observed anomaly is simply random noise. While the EMH posits market efficiency, it does not preclude temporary deviations. Ignoring a potentially significant pattern could mean failing to act in the client's best interests, thereby breaching the duty of care. However, this is less severe than actively engaging in market abuse. A third incorrect approach would be to share the observed pattern with other brokers or clients without proper authorization or consideration of its implications. This could lead to widespread exploitation of the perceived inefficiency, potentially destabilizing the market and creating an unfair playing field, which would also be a breach of regulatory obligations and ethical standards. The professional decision-making process for similar situations should involve a systematic evaluation. 1. Understand the observed phenomenon. What is the pattern and what might be its cause? 2. Assess regulatory implications. Does acting on this information potentially violate any laws or regulations, e.g., market abuse, insider dealing? 3. Consider ethical duties. Does this action align with the duty to act in the client's best interest while also upholding market integrity and fairness? 4. Investigate further. if the pattern is unclear or potentially problematic. Conduct due diligence to understand its nature and implications before taking any action. 5. Seek guidance. If in doubt, consult compliance departments or legal counsel. Question 3. The efficiency study reveals that the firm's current client onboarding process for new investment platforms is time-consuming and resource-intensive. To streamline operations, management proposes implementing a new digital platform that automates much of the initial data collection and account setup. Considering the firm's commitment to client relationship management and regulatory obligations, which of the following approaches best balances efficiency with client service and compliance? Option A. Schedule individual calls with all existing clients to explain the transition to the new platform, offer personalized assistance with the setup, and gather feedback on their experience. Option B. Inform clients via a brief website announcement that a new platform is being introduced and that all onboarding will be handled through it from next month, with no further proactive communication. Option C. Send a comprehensive email detailing the new platform's features and benefits, with a link to a self-service portal for clients to complete the onboarding process at their convenience. Option D. Implement the new platform immediately for all new clients, assuming they will adapt to the digital process without explicit guidance or support. The correct answer is C. Send a comprehensive email detailing the new platform's features and benefits, with a link to a self-service portal for clients to complete the onboarding process at their convenience. Explanation: this scenario is professionally challenging because it requires balancing the firm's operational efficiency with the fundamental regulatory and ethical obligation to provide suitable advice and maintain client trust. The pressure to streamline processes can inadvertently lead to a depersonalized client experience, potentially compromising the quality of advice and client satisfaction. Careful judgment is required to ensure that efficiency measures do not erode the core principles of client relationship management. The correct approach involves a proactive and personalized communication strategy that acknowledges the client's existing relationship and preferences while introducing the new system. This demonstrates respect for the client, builds trust, and allows for a smoother transition. It aligns with the Financial Conduct Authority's FCA principles, particularly Principle 6 Customers' Interests and Principle 7 Communications with Clients, which mandate treating customers fairly and communicating in a clear, honest, and not misleading way. By offering a dedicated point of contact and a tailored onboarding process, the firm upholds its duty of care and commitment to client satisfaction. An incorrect approach that focuses solely on a blanket email notification without offering personalized support fails to meet the FCA's communication standards. It risks being perceived as impersonal and dismissive of client needs, potentially leading to confusion, frustration, and a breach of Principle 6. Another incorrect approach, which involves assuming clients will adapt without any proactive engagement, neglects the firm's responsibility to facilitate a positive client experience. This passive stance can result in clients feeling unsupported and undervalued, undermining the client relationship and potentially leading to complaints or client attrition, thereby failing to act in the client's best interests. A third incorrect approach, which prioritizes the immediate convenience of the firm by forcing clients onto the new system without adequate explanation or support, is ethically unsound and likely to contravene regulatory expectations. It prioritizes internal efficiency over client welfare and can lead to significant client dissatisfaction and reputational damage. The professional reasoning process for similar situations should involve a thorough assessment of the impact of any proposed change on the client relationship. This includes considering how the change will be communicated, what support will be provided, and how client feedback will be managed. Firms should always prioritize client interests and regulatory compliance, ensuring that efficiency gains do not come at the expense of ethical conduct and client trust. A client-centric approach, even when implementing operational changes, is paramount. Question 4. Operational review demonstrates that a client's investment portfolio, managed by your firm, has been constructed with a focus on achieving broad market exposure. The current portfolio holds a significant number of individual equities across various sectors, but analysis indicates a high degree of correlation between many of these holdings. Which of the following approaches to portfolio construction would best align with the regulatory framework for building diversified investment portfolios under the FCA's Conduct of Business Sourcebook? Option A. Selecting additional equities based solely on their recent strong past performance, irrespective of their correlation with existing holdings. Option B. Rebalancing the portfolio to include a wider range of asset classes with low historical correlation, such as bonds, property, and alternative investments, in addition to equities, to reduce unsystematic risk. Option C. Increasing the number of individual equities held within the existing sectors to further broaden market representation. Option D. Concentrating the portfolio into a few high-growth sectors with the highest recent performance figures. The correct answer is B. Rebalancing the portfolio to include a wider range of asset classes with low historical correlation, such as bonds, property, and alternative investments, in addition to equities, to reduce unsystematic risk. Explanation: this scenario is professionally challenging because it requires the broker to balance client objectives with regulatory obligations and ethical considerations in portfolio construction. The FCA's Conduct of Business Sourcebook, COBS, is paramount, particularly COBS 9, Information about Investments, Investment Advice and Portfolio Management, and COBS 10, Appropriateness and Suitability. The core challenge lies in ensuring that the diversified portfolio is not only aligned with the client's stated risk tolerance and objectives, but also that the diversification strategy itself is robust and meets regulatory expectations for client best interests. The correct approach involves constructing a diversified portfolio that genuinely reduces unsystematic risk without compromising the client's ability to achieve their financial goals, while also ensuring transparency and suitability. This means selecting a range of assets across different asset classes, geographies, and sectors, where the correlation between assets is low. This strategy directly addresses the regulatory requirement to act honestly, fairly, and professionally in accordance with the best interests of the client. COBS 2. 1R. Furthermore, it aligns with the principles of suitability. COBS 9. 1R, ensuring that the recommended portfolio is appropriate for the client's knowledge and experience, financial situation, and investment objectives. The emphasis on low correlation is a key element of effective diversification, which is a fundamental principle of prudent investment management and a cornerstone of meeting client best interests. An incorrect approach that focuses solely on the number of holdings without considering their correlation or the client's specific circumstances fails to meet the suitability requirements. Simply holding many assets does not guarantee diversification if those assets are highly correlated, meaning they are likely to move in the same direction. This could expose the client to undue risk, contrary to their best interests. Another incorrect approach that prioritizes achieving the highest possible short-term returns through concentrated holdings in a few high-growth sectors, even if presented as diversified within those sectors, would likely be deemed unsuitable. This strategy would disregard the principle of risk mitigation inherent in true diversification, and could lead to a portfolio that is overly exposed to specific market risks, failing the suitability test and the overarching duty to act in the client's best interests. A third incorrect approach that involves selecting assets based on recent past performance alone, without a thorough analysis of their underlying characteristics, correlation, and long-term prospects, is also professionally unacceptable. Past performance is not a reliable indicator of future results, and a portfolio built on this premise would not be adequately diversified or suitable for the client's long-term objectives, potentially leading to regulatory breaches under COBS. The professional decision-making process for similar situations should involve a systematic assessment of the client's profile, including their risk tolerance, investment objectives, financial situation, knowledge, and experience. This should be followed by the development of a diversification strategy that considers asset allocation, correlation analysis, and the selection of appropriate investment vehicles. Regular reviews and adjustments to the portfolio, in light of changing market conditions and client circumstances, are also crucial to ensure ongoing suitability and compliance with regulatory requirements. Question 5. The audit findings indicate that a series of financial transactions, which should have triggered a Suspicious Activity Report (SAR) to the National Crime Agency (NCA) under the Proceeds of Crime Act 2002, were not reported within the required timeframe due to an oversight. The client, a significant business introducer, has expressed concern about the reputational impact of such a report and has suggested delaying the SAR submission until the next quarterly regulatory update, arguing that the transactions were not definitively illicit. Your firm's compliance officer is currently on annual leave. Which of the following is the most appropriate immediate course of action for the broking firm? Option A. Submit a SAR to the NCA immediately without consulting any internal compliance personnel to ensure the reporting obligation is met. Option B. Advise the client that the reporting will be delayed until the next quarterly update as suggested to manage reputational concerns. Option C. Immediately escalate the matter to the designated MLRO, Money Laundering Reporting Officer, or, in their absence, the most senior compliance function representative available to initiate the SAR process and internal review. Option D. Ignore the audit finding as the client asserts the transactions were not definitively illicit and no direct evidence of criminal activity has been found. The correct answer is C. Immediately escalate the matter to the designated MLRO, Money Laundering Reporting Officer, or, in their absence, the most senior compliance function representative available to initiate the SAR process and internal review. Explanation. This scenario presents a professional challenge because it involves a direct conflict between a client's desire to minimize immediate reporting burdens and the firm's absolute regulatory obligation to report financial transactions accurately and promptly. The auditor's findings highlight a potential breach of reporting requirements, which carries significant implications for the firm's compliance status and reputation. Careful judgment is required to navigate the client's pressure while upholding regulatory integrity. The correct approach involves immediately escalating the issue internally to the firm's compliance officer and designated MLRO, Money Laundering Reporting Officer. This is the right professional practice because the Financial Conduct Authority, FCA Handbook, specifically the SISC, Senior Management Arrangements, Systems and Controls, and SUP, Supervision Manual sections, mandates that firms have robust systems and controls in place to identify and report suspicious financial activity. Prompt internal escalation ensures that the firm can conduct a thorough internal investigation, assess the materiality of the reporting lapse, and make the necessary disclosures to the FCA within the stipulated timeframes. This proactive stance demonstrates adherence to the principles of integrity and due skill, care, and diligence, as well as the specific reporting obligations under the Proceeds of Crime Act 2002, POCA, and its associated money laundering regulations. An incorrect approach would be to agree with the client's suggestion to delay reporting until the next scheduled regulatory submission. This is a regulatory failure because it directly contravenes the FCA's expectations for timely reporting of suspicious transactions. The FCA requires immediate reporting of suspicious activity, not deferral to convenience or client preference. This approach also risks creating a false impression of compliance and could be viewed as an attempt to conceal a potential breach, undermining the firm's integrity. Another incorrect approach would be to dismiss the auditor's findings as minor and not report them at all, relying on the client's assurance that no illicit activity occurred. This is a significant ethical and regulatory failure. The auditor's role is to identify potential control weaknesses and breaches. Their findings must be treated with seriousness. Failing to report, even if the client is persuasive, abdicates the firm's responsibility to maintain a compliant and transparent operational framework. It also ignores the potential for the firm to be complicit in money laundering or terrorist financing if the suspicion is indeed valid. A third incorrect approach would be to attempt to rectify the reporting omission by submitting a retrospective report without informing senior management or the compliance function. This is a dangerous and unprofessional course of action. It bypasses established internal control procedures designed to ensure accurate and complete regulatory reporting. It also prevents the firm from properly assessing the root cause of the reporting failure, implementing corrective actions, and managing the regulatory relationship effectively. Such an action could be seen as an attempt to self-correct without proper oversight, potentially leading to further compliance issues if the retrospective report is inaccurate or incomplete. The professional decision-making process for similar situations should involve a clear understanding of regulatory obligations, a commitment to ethical conduct, and a robust internal escalation protocol. When faced with a discrepancy or potential breach, the professional should 1. Acknowledge and document the issue. 2. Consult relevant regulatory guidance and internal policies. 3. Immediately escalate the matter to the appropriate internal authority, e.g., Compliance Officer, MLRO, Senior Management. 4. Cooperate fully with internal investigations and regulatory inquiries. 5. Prioritize regulatory compliance and client best interests, understanding that these are not mutually exclusive, but are intrinsically linked through ethical and legal frameworks. Question 6. Consider a scenario where a broking firm is onboarding a new retail client. The firm's internal policy aims to optimize the client onboarding process for speed and efficiency while adhering to regulatory requirements for verifying client identity. Which of the following approaches best balances these objectives and meets the regulatory framework for the Advanced Broking Exam, CII jurisdiction? Option A. Accept a self-declaration of identity from the client, with no independent verification, as long as the client provides a valid email address and telephone number. Option B. Prioritize completing the onboarding process within a strict time limit, accepting any form of identification provided by the client without scrutinizing its validity or suitability. Option C. Rely solely on a single, standard form of identification, such as a recent utility bill for all clients, without assessing the client's risk profile or the reliability of the document. Option D. Primarily utilize electronic verification methods for all clients, and if these are inconclusive or indicate a higher risk profile, request additional supporting documentation as specified in the firm's enhanced due diligence procedures. The correct answer is D. Primarily utilize electronic verification methods for all clients, and if these are inconclusive or indicate a higher risk profile, request additional supporting documentation as specified in the firm's enhanced due diligence procedures. Explanation. This scenario presents a professional challenge due to the inherent tension between efficient client onboarding and the stringent regulatory requirements for verifying client identity under the Advanced Broking Exam, CII, jurisdiction. The firm must balance the need to attract and retain business with its legal and ethical obligations to prevent financial crime. Failure to implement robust KYC procedures can lead to significant regulatory sanctions, reputational damage, and potential involvement in illicit activities. Careful judgment is required to select verification methods that are both effective and proportionate to the risk presented by the client. The correct approach involves a multifaceted strategy that combines readily available electronic verification with a clear escalation path for cases where electronic methods are insufficient or raise red flags. This approach is right because it aligns with the principles of the UK's money laundering regulations, MLR, and the Financial Conduct Authority's, FCA, guidance on client due diligence. Specifically, the MLR's mandate that firms take appropriate measures to verify the identity of their clients. The FCA's handbook, e.g., CISC, further elaborates on the need for robust systems and controls, including effective customer due diligence. By first attempting electronic verification, the firm leverages efficient and often reliable methods to meet the basic identification requirements. The subsequent requirement for additional documentation for high-risk clients, or when electronic verification fails, directly addresses the need for enhanced due diligence, a cornerstone of anti-money laundering (AML) efforts. This layered approach ensures that the firm is not overly reliant on a single method and can adapt its verification process based on the specific circumstances and risk profile of the client, thereby fulfilling its regulatory obligations. An incorrect approach that relies solely on self-declaration, without any independent verification, fails to meet the fundamental requirements of the MLRs. This approach is ethically and regulatorily unsound, as it provides no assurance that the client is who they claim to be, leaving the firm vulnerable to being used for money laundering or terrorist financing. Another incorrect approach that involves accepting a single, low-assurance document, e.g., a utility bill that may not be consistently updated or easily forged, as definitive proof of identity for all clients, regardless of risk, is also professionally unacceptable. While it attempts verification, it lacks the robustness expected by regulators for comprehensive identity checks, particularly for higher-risk individuals or entities. This can lead to a false sense of security and still expose the firm to regulatory scrutiny. A third incorrect approach that prioritizes speed over accuracy by accepting any form of identification without assessing its validity or suitability for the client's risk profile is equally flawed. This demonstrates a disregard for the spirit and letter of the regulations, which require a risk-based approach to client due diligence. The professional decision-making process for similar situations should begin with a thorough understanding of the relevant regulatory framework, including the MLRs and FCA guidance. Firms must then establish a clear, risk-based client due diligence policy that outlines the different levels of verification required for various client types and risk profiles. When onboarding a new client, the process should start with the least intrusive but effective verification methods, such as electronic checks. If these methods are insufficient or indicate potential risks, the firm must have predefined procedures for escalating to more rigorous verification steps, including the request for specific, reliable documentation. Continuous monitoring and periodic reviews of client information are also crucial components of an effective KYC framework. Question 7. The assessment process reveals that a long-standing client who has historically been risk-averse is now expressing a strong desire to invest a significant portion of their portfolio in a highly speculative, emerging technology stock. The client states they have a gut feeling this stock will explode in value, citing recent positive news articles they have read. The broker observes the client seems unusually excited and dismissive of any potential downsides. Which of the following represents the most appropriate course of action for the broker, adhering strictly to the Advanced Broking Exam, CII, regulatory framework? Option A. Inform the client that their sudden shift in risk appetite is concerning and suggest they seek advice from a financial psychologist before proceeding with any investment. Option B. Immediately execute the client's requested trade, as the client has the ultimate authority over their investment decisions, and the broker's role is to facilitate these. Option C. Advise the client that their decision appears to be influenced by recent positive news and their emotional state, and proceed to discuss the potential risks and alternative, more diversified investment strategies that align with their historical risk profile. Option D. Reassure the client that their gut feeling is often accurate and proceed with the investment, while also suggesting they increase their allocation to speculative assets to capitalize on this perceived trend. The correct answer is B. Immediately execute the client's requested trade, as the client has the ultimate authority over their investment decisions, and the broker's role is to facilitate these. Explanation. The assessment process reveals a scenario where a broker must navigate a client's investment decisions influenced by behavioral finance principles, specifically cognitive biases and emotional responses. This is professionally challenging because the broker's primary duty is to act in the client's best interests, which requires identifying and mitigating the impact of these biases, rather than simply facilitating the client's stated wishes if those wishes are demonstrably detrimental due to such influences. The broker must balance client autonomy with their fiduciary responsibility. The correct approach involves the broker actively identifying potential cognitive biases, such as recency bias or confirmation bias, and emotional influences like fear or greed that are impacting the client's decision-making. The broker should then engage in a structured conversation to educate the client about these biases, explain how they might be affecting their judgment, and present objective, evidence-based alternatives or a more balanced perspective. This aligns with the Financial Conduct Authority's FCA principles, particularly Principle 6, Customers' Interests, and Principle 7, Communications with Clients, which mandate that firms must pay due regard to the interests of their customers and communicate with them in a way that is clear, fair, and not misleading. The broker's role is to guide the client towards rational decision-making, even if it means challenging their initial impulses. An incorrect approach would be to simply execute the client's instructions without question, even if the broker suspects the decision is driven by a short-term emotional reaction or a cognitive bias. This fails to uphold the duty to act in the client's best interests, as it allows a potentially suboptimal decision to be made without intervention. This could breach FCA Principle 6. Another incorrect approach would be to dismiss the client's concerns outright or to patronize them, which would damage the client relationship and fail to address the underlying behavioral influences constructively. This would also likely breach FCA Principle 7 by not communicating fairly or clearly. A further incorrect approach might be to overemphasize the potential for future gains to appease the client's emotional state, thereby reinforcing a potentially irrational decision, which would be a failure to provide balanced and objective advice. The professional decision-making process in such situations requires a proactive and empathetic approach. Brokers should be trained to recognize common behavioral biases. When a client presents a decision that appears influenced by such biases, the broker should: 1. Listen actively to understand the client's rationale and emotional state. 2. Gently probe the client's reasoning, asking open-ended questions that encourage reflection. 3. Educate the client about relevant behavioral finance concepts in an accessible manner. 4. Present objective data and alternative strategies, highlighting potential risks and rewards without emotional language. 5. Document the advice given and the client's decision, particularly if the client proceeds against advice. Question 8. Market research demonstrates that clients often express a desire for high investment returns. A broker is meeting with a new client who states, "I want to make as much money as possible, as quickly as possible. I'm not worried about losing some money if it means I could get big gains." The broker's primary responsibility is to define the client's investment objectives and risk tolerance. Which of the following approaches best aligns with regulatory requirements and ethical best practice for establishing this client's true investment profile? Option A. Immediately advise the client that their stated objective is unrealistic and potentially dangerous, and refuse to proceed with any investment recommendations until they revise their expectations. Option B. Acknowledge the client's stated desire for high returns and proceed to recommend a portfolio heavily weighted towards high-risk, high-growth assets, assuming their stated comfort with risk is genuine. Option C. Focus on the broker's commission structure and recommend investments that offer the highest commission, assuming that if the client makes money, they will be satisfied regardless of the risk taken. Option D. Explain to the client that while high returns are desirable, significant risk is inherent, and then engage in a detailed discussion about their capacity to absorb potential losses, their emotional response to market volatility, and their actual financial situation to determine a suitable risk profile. The correct answer is B. Acknowledge the client's stated desire for high returns and proceed to recommend a portfolio heavily weighted towards high-risk, high-growth assets, assuming their stated comfort with risk is genuine. Explanation. This scenario is professionally challenging because it requires the broker to balance the client's stated desires with a realistic assessment of their capacity and willingness to accept risk, all within the strict regulatory framework governing financial advice. The FCA's principles for businesses, particularly Principle 2, skill, care, and diligence, and Principle 3, conduct business with due regard to the interests of customers, are paramount. Furthermore, the FCA's Conduct of Business Sourcebook, COBS, mandates that firms must take reasonable steps to ensure that any advice given is suitable for the client. This involves a thorough understanding of the client's investment objectives, knowledge and experience, financial situation, and risk tolerance. The challenge lies in eliciting this information accurately and then translating it into appropriate investment recommendations, avoiding assumptions or undue influence. The correct approach involves a structured and comprehensive fact-finding process that goes beyond superficial questioning. It requires the broker to actively probe the client's understanding of risk, their emotional response to potential losses, and their capacity to absorb such losses without jeopardizing their financial well-being. This deep dive into the client's risk tolerance, alongside their financial situation and investment objectives, ensures that the subsequent recommendations are genuinely suitable and aligned with regulatory expectations. This aligns with COBS 9, which details requirements for assessing suitability. An incorrect approach that focuses solely on the client's stated desire for high returns without adequately exploring their risk tolerance is a significant regulatory and ethical failure. This demonstrates a lack of due diligence and a failure to act in the client's best interests, potentially exposing them to investments they cannot emotionally or financially withstand. Such an approach breaches Principle 2 and Principle 3, as well as the specific suitability requirements under COBS 9. Another incorrect approach that prioritizes the broker's commission or sales targets over the client's needs is a clear breach of regulatory and ethical standards. This is a conflict of interest that must be managed transparently and in accordance with FCA rules, particularly those relating to conflicts of interest and acting honestly, fairly, and professionally in accordance with the best interests of clients. A third incorrect approach that makes assumptions about the client's risk tolerance based on their age or profession, without direct verification, is also professionally unacceptable. This demonstrates a lack of individualized assessment and can lead to unsuitable recommendations, violating the core principles of suitability and customer best interests. The professional decision-making process for similar situations should involve a systematic approach. 1. Initiate a comprehensive fact-finding process covering all aspects of the client's financial situation, investment objectives, knowledge, experience, and crucially, their risk tolerance. 2. Employ open-ended questions and active listening to encourage detailed responses regarding risk. 3. Use scenario-based questions to gauge the client's emotional and financial reaction to potential market downturns. 4. Document all discussions and assessments thoroughly. 5. Formulate recommendations that are demonstrably suitable based on the gathered information, prioritizing the client's best interests above all else. 6. Regularly review and update the client's profile and recommendations. Question 9. System analysis indicates that a long-standing corporate client, whose usual business involves the import and export of consumer goods, has requested an immediate transfer of a substantial sum to an offshore entity in a jurisdiction known for its lax financial regulations. The purpose stated for the transfer is to facilitate a new, urgent supply chain investment, but the client has provided minimal supporting documentation and has been evasive when questioned about the specifics of this investment. The broker is aware of the client's generally good standing, but is concerned about the unusual nature and destination of this transaction. Which of the following represents the most appropriate course of action for the broker, adhering strictly to UK anti-money laundering, AML, regulations and FCA guidance? Option A. Immediately refuse the transaction and terminate the business relationship with the client, reporting the matter to the National Crime Agency, NCA, without further investigation. Option B. Conduct enhanced due diligence, ED, by seeking further detailed information and supporting documentation from the client regarding the nature and purpose of the investment, and if suspicions persist, consider reporting to the NCA. Option C. Advise the client to use a different financial institution for this specific transaction to avoid any potential regulatory scrutiny on the broker's firm. Option D. Proceed with the transfer as requested, given the client's long-standing relationship and the urgency of the stated business need, while making a note of the transaction in the client file. The correct answer is D. Proceed with the transfer as requested, given the client's long-standing relationship and the urgency of the stated business need, while making a note of the transaction in the client file. Explanation. This scenario presents a professional challenge due to the inherent tension between client service and regulatory compliance, specifically concerning anti-money laundering, AML obligations. The broker must balance the need to facilitate a client's legitimate business transactions with the imperative to prevent the firm from being used for illicit purposes. This requires a nuanced understanding of risk assessment, customer due diligence, CDD, and ongoing monitoring, all within the framework of the UK's AML regulations, primarily the money laundering, terrorist financing and transfer of funds, information on the payer, Regulations 2017, MLR 2017, and guidance from the Financial Conduct Authority, FCA. The correct approach involves a robust and proportionate application of CDD measures, including enhanced due diligence, ED, where higher risks are identified. This means not only verifying the client's identity, but also understanding the nature and purpose of their business, the source of their funds, and the expected transaction patterns. When a transaction deviates significantly from this established profile, the broker has a regulatory duty to investigate further, potentially including seeking additional information from the client, and if suspicions persist, reporting to the National Crime Agency, NCA, via a Suspicious Activity Report, SAR. This proactive and diligent approach aligns with the FCA's principles for business, particularly Principle 3, Managing Affairs Honestly, and Principle 7, Communications with Clients, and the overarching objectives of the MLRs 2017 to combat financial crime. An incorrect approach would be to proceed with the transaction without adequate investigation, simply because the client is a long-standing one, or because the broker feels pressured to complete the deal quickly. This failure to escalate or investigate a potentially suspicious transaction directly contravenes the MLRs 2017, which mandate ongoing monitoring and the reporting of suspicious activity. Such inaction exposes the firm to significant regulatory penalties, reputational damage, and the risk of facilitating money laundering. Another incorrect approach would be to immediately terminate the relationship and report the client without any attempt to understand the deviation, which might be overly punitive and not proportionate to the identified risk, potentially failing to gather crucial information that could aid law enforcement. A third incorrect approach would be to rely solely on the client's verbal assurances without seeking documentary evidence or further clarification, which falls short of the enhanced due diligence expected in higher-risk situations. The professional decision-making process should involve a risk-based assessment. First, identify the red flags: the unusual size and nature of the transaction, its deviation from the client's usual activity, and the potential for it to be linked to high-risk jurisdictions or activities. Second, apply proportionate CDD measures, including EDD if necessary, to understand the client and the transaction. Third, if suspicions remain after initial investigation, escalate internally and consider reporting to the NCA. Throughout this process, maintain clear and accurate records of all actions taken and decisions made. Question 10. Stakeholder feedback indicates a growing client interest in equity investments, with a particular focus on understanding the differences between common and preferred stock for portfolio diversification. A client who has expressed a moderate risk tolerance and a desire for both capital growth and income is seeking guidance on which type of equity might be more appropriate for their investment objectives. Which of the following approaches best reflects the professional and regulatory requirements for advising this client? Option A. Recommend a diversified portfolio of common stocks, explaining their potential for capital appreciation and dividend income, while also highlighting their inherent volatility and the importance of thorough company research. Option B. Recommend common stock as the primary investment, given the client's desire for capital growth, and suggest preferred stock only if the client expresses concerns about market fluctuations. Option C. Recommend a balanced allocation between common and preferred stocks, without a detailed discussion of the specific risk-return profiles of each in relation to the client's stated objectives. Option D. Recommend a portfolio solely comprised of preferred stocks, emphasizing their fixed dividend payments and priority in liquidation as a measure of stability. Correct answer is A. Recommend a diversified portfolio of common stocks, explaining their potential for capital appreciation and dividend income, while also highlighting their inherent volatility and the importance of thorough company research. Explanation: this scenario is professionally challenging because it requires a broker to balance client needs with regulatory obligations and ethical considerations when advising on equity investments. The broker must assess the client's risk tolerance and investment objectives, and then recommend suitable equity types that align with these factors, while also adhering to the principles of treating customers fairly and providing appropriate advice as mandated by the Financial Conduct Authority (FCA) Handbook, specifically in the context of the Conduct of Business (COBS) Sourcebook. The correct approach involves a thorough understanding of the client's financial situation, investment goals, and risk appetite, and then recommending equity types that are most suitable. This aligns with FCA principles, particularly Principle 2 Skill, Care, and Diligence, and Principle 6 Customers' Interests. For common stock, this means understanding its potential for capital growth and dividends, but also its higher volatility and risk. For preferred stock, it means recognizing its fixed dividend payments and priority over common stock in liquidation, but potentially lower growth prospects and interest rate sensitivity. The broker must then explain these characteristics clearly to the client, enabling an informed decision. An incorrect approach would be to recommend only common stock without a detailed assessment of the client's risk tolerance. This fails to uphold the duty to act in the client's best interests and could lead to the client taking on more risk than they are comfortable with, potentially breaching COBS 9A, appropriateness. Another incorrect approach would be to recommend only preferred stock, assuming it is always safer, without considering the client's potential for capital appreciation and their specific investment objectives. This could limit the client's potential returns and again fail to meet their individual needs. Recommending a mix without understanding the client's specific circumstances and explaining the trade-offs of each equity type would also be an inappropriate recommendation, as it lacks the personalized assessment required by FCA regulations. Professionals should adopt a structured decision-making process. First, gather comprehensive client information, financials, goals, risk tolerance. Second, analyze the characteristics of different equity types, common vs. preferred, in relation to the client's profile. Third, present a clear explanation of the risks and benefits of each suitable option. And fourth, document the advice given and the client's decision. This ensures that recommendations are not only compliant with FCA regulations, but also ethically sound and tailored to the individual client. Question 11. The evaluation methodology shows that a broker is advising a client on the acquisition of a private company. The broker has considered using discounted cash flow (DCF) analysis to estimate the intrinsic value and has also looked at comparable company multiples. Given the specific challenges of valuing private entities, which valuation approach best demonstrates professional diligence and adherence to regulatory expectations for providing objective advice? Option A. Primarily employing discounted cash flow (DCF) analysis, supplemented by relative valuation techniques as a cross-check. Option B. Applying a valuation method that is easiest to calculate, regardless of its suitability for private companies. Option C. Using a single valuation technique without considering its limitations or corroborating it with other methods. Option D. Solely relying on relative valuation using multiples from publicly traded companies, assuming they are sufficiently similar. Correct answer is A. Primarily employing discounted cash flow (DCF) analysis, supplemented by relative valuation techniques as a cross-check. Explanation. This scenario presents a professional challenge because a broker is tasked with advising a client on the valuation of a private company for a potential acquisition. The challenge lies in selecting the most appropriate valuation technique, considering the limited publicly available data for private companies, and the need to provide a robust and defensible valuation that aligns with regulatory expectations and ethical duties. The broker must ensure the advice provided is objective, fair, and based on sound principles, avoiding any misrepresentation or undue influence on the client's decision-making. The correct approach involves using a combination of discounted cash flow (DCF) and relative valuation techniques, with a strong emphasis on the DCF method due to the specific nature of private company valuation. The DCF method, when applied correctly, projects future cash flows and discounts them back to their present value, providing an intrinsic valuation. This is particularly relevant for private companies, where future growth prospects and unique operational characteristics are key drivers of value, and where comparable public companies may not perfectly mirror the target's business. Regulatory guidelines, such as those pertaining to fair dealing and professional competence, require brokers to use methodologies that are appropriate for the asset being valued and to provide advice that is in the best interests of the client. A blended approach, where DCF is primary and relative valuation serves as a cross-check, demonstrates due diligence and a comprehensive understanding of the company's value drivers. Using only relative valuation without significant adjustments would be an incorrect approach. This method relies on comparing the target company to similar publicly traded companies or recent transactions. For private companies, finding truly comparable entities can be difficult, and market multiples may not accurately reflect the unique risks, growth potential, or control premium associated with a private business. This could lead to a valuation that is either too high or too low, failing to meet the regulatory requirement of providing fair and accurate advice. Ethically, it could be seen as a shortcut that compromises the quality of advice. Another incorrect approach would be to rely solely on a single valuation technique, without considering its limitations or corroborating it with other methods. For instance, solely using a precedent transaction multiple without a thorough understanding of the deal specifics and the target company's current situation would be flawed. This ignores the need for a comprehensive valuation that considers both the company's intrinsic worth and its market positioning. Regulatory expectations often imply a need for a well-supported valuation, and relying on a single, potentially inappropriate metric fails to meet this standard. The professional decision-making process should involve a thorough understanding of the client's objectives, the nature of the target company, and the available data. The broker should first identify the most suitable primary valuation methodology, considering the company's stage of development, industry, and data availability. In this case, DCF is a strong candidate for a private company. Subsequently, the broker should consider complementary methods, such as relative valuation, to provide a range of values and to cross-check the primary valuation. Transparency with the client regarding the methodologies used, their assumptions, and their limitations is crucial. This ensures the client can make an informed decision based on a well-reasoned valuation. Question 12. System analysis indicates that a client, who is a director of a publicly listed company, contacts their broker to place a large sell order for shares in that company. The client states they have some very important non-public information that makes them believe the share price will fall significantly in the near future. What is the most appropriate course of action for the broker to take? Adhering strictly to the FCA's Market Abuse Regulation (MAR). Option A. Inform the client that the information they possess appears to be inside information. Explain the prohibition against insider dealing under MAR, and advise them not to proceed with the trade until the information is made public or they can confirm it is not inside information. Option B. Advise the client to wait for a few days to see if the share price moves before executing the trade. Option C. Execute the sell order immediately as instructed by the client, as the client is acting on their own information. Option D. Immediately report the client to the FCA for suspected insider dealing without further discussion. The correct answer is C. Execute the sell order immediately as instructed by the client, as the client is acting on their own information. Explanation: this scenario is professionally challenging because it requires a broker to balance their duty to their client with their obligation to prevent market abuse. The broker must recognize the potential for insider dealing without having definitive proof, and act responsibly to avoid facilitating illegal activity, while also not unduly harming their client's legitimate trading intentions. Careful judgment is required to assess the sensitivity of the information and the potential for it to be considered inside information under the relevant regulations. The correct approach involves the broker exercising caution and seeking clarification from the client regarding the source and nature of the information. This demonstrates a commitment to regulatory compliance by proactively addressing potential market abuse. Specifically, the broker should inform the client that the information appears to be inside information and explain the legal implications of trading on such information, advising them against proceeding until the information is made public or the client can confirm it is not inside information. This aligns with the FCA's Market Abuse Regulation (MAR), which prohibits insider dealing and requires firms to have systems and controls in place to prevent it. The broker's actions here are consistent with the principles of integrity and due skill, care, and diligence expected of certified and approved persons under the FCA handbook. An incorrect approach would be to proceed with the trade without question. This fails to uphold the broker's regulatory obligations to prevent market abuse and could lead to the broker becoming complicit in insider dealing. It disregards the potential for serious legal and reputational consequences for both the client and the firm, and violates the spirit and letter of MAR. Another incorrect approach would be to immediately report the client to the regulator without first attempting to understand the situation with the client. While vigilance is important, this approach could be seen as overly aggressive and potentially damaging to the client relationship if the information turns out not to be inside information. It bypasses the opportunity for the client to clarify the situation and for the broker to provide appropriate guidance, potentially leading to unnecessary regulatory scrutiny. A further incorrect approach would be to ignore the potential issue and execute the trade, assuming the client is acting legitimately. This demonstrates a lack of due diligence and a failure to recognize the red flags presented by the information. It prioritizes client instruction over regulatory responsibility, which is unacceptable under the FCA's framework. The professional decision-making process for similar situations should involve a risk-based assessment. Brokers must be aware of the types of information that constitute inside information and be vigilant for potential indicators. When such indicators arise, the primary step is to engage with the client to understand the source and nature of the information. If there is a genuine concern about insider dealing, the broker must then take appropriate steps, which may include advising the client against the trade, seeking further internal guidance, and if necessary, reporting to the regulator, all while maintaining client confidentiality where appropriate and legally permissible. Question 13. The performance metrics show a consistent trend of slightly longer execution times for certain types of client orders, although no direct client complaints have been received regarding these specific instances. The broking firm is under pressure to improve its overall efficiency. Which of the following actions best demonstrates a commitment to regulatory compliance and client best interests in this situation? Option A. Conduct a detailed review of the firm's order execution policies and procedures to identify any inefficiencies or potential areas for improvement that could lead to better client outcomes and implement necessary changes. Option B. Implement a new internal target for execution speed that is significantly more aggressive, without a corresponding review of the execution process, and hold individual brokers accountable for meeting this new target. Option C. Instruct individual brokers to prioritize speed above all else when executing these types of orders, even if it means accepting slightly less favorable prices or increased settlement risks. Option D. Continue with the current execution process, focusing on other areas where efficiency gains can be more readily achieved, and consider the current execution times as acceptable given the absence of client complaints. The correct answer is A. Conduct a detailed review of the firm's order execution policies and procedures to identify any inefficiencies or potential areas for improvement that could lead to better client outcomes, and implement necessary changes. Explanation: this scenario presents a professional challenge because it requires the broking firm to balance the efficiency of its operations with its fundamental regulatory obligations to act in the best interests of its clients and to ensure fair treatment. The pressure to meet performance metrics, while a legitimate business objective, must not override compliance with the FCA's principles for businesses and specific conduct of business rules. The firm needs to exercise careful judgment to identify potential conflicts and ensure that client outcomes are not compromised by internal operational pressures. The correct approach involves a proactive and systematic review of the execution process to identify and rectify any systemic issues that might be leading to poor client outcomes, even if these outcomes are not immediately obvious as breaches. This approach prioritizes client best interests and regulatory compliance by seeking to improve the execution process itself, rather than simply accepting the current performance as a baseline. This aligns with the FCA's emphasis on treating customers fairly (TCF) and the general duty to act with integrity, skill, care, and diligence. Specifically, Principle 6, Customers' Interests, and Principle 7, Communications with Clients, of the FCA's Principles for Businesses are directly relevant, as is the need to ensure that systems and controls are adequate to prevent breaches of the handbook. An incorrect approach would be to dismiss the performance metrics as merely an internal target and to continue with the current execution process, assuming no client detriment has occurred. This fails to recognize that the metrics might be an early warning sign of potential issues that could lead to client detriment in the future, or that the current process, while not causing overt harm, is not achieving optimal outcomes for clients. This approach risks a breach of Principle 6 by not actively seeking to secure the best possible outcomes for clients. Another incorrect approach would be to focus solely on the speed of execution without considering the quality or cost. Efficiency is important. It should not come at the expense of achieving the best possible result for the client in terms of price, speed, likelihood of execution, and settlement. This could lead to breaches of COBS 11(2) 1R, which requires firms to take all sufficient steps to obtain, when executing orders, the best possible result for the client in terms of the total consideration, taking into account price, costs, speed, likelihood of execution, and settlement, size, nature, or any other consideration relevant to the order. A further incorrect approach would be to blame individual brokers for the performance metrics without investigating the underlying operational processes. This fails to address the root cause of any potential issues and could lead to unfair treatment of staff, while also neglecting the firm's responsibility to have robust systems and controls in place to ensure effective and compliant execution. This could be seen as a failure to uphold Principle 3, Management and Control, of the FCA's Principles for Businesses. The professional decision-making process should involve a thorough investigation of the performance metrics, identifying any trends or anomalies. This should be followed by a review of the firm's execution policies and procedures, assessing their effectiveness against regulatory requirements and client best interests. Where deficiencies are identified, remedial actions should be implemented and their effectiveness monitored. This systematic and client-centric approach ensures that operational efficiency is pursued in a manner that is fully compliant with regulatory expectations and ethical standards. Question 14. The risk matrix shows that Treasury bills offer a lower yield but are considered highly liquid and carry minimal credit risk, while commercial paper offers a higher yield but with increased credit risk depending on the issuer's financial standing. Repurchase agreements present a yield that can vary based on market conditions and collateral quality, with potential interest rate and counterparty risks. A client has expressed a desire for capital preservation and a moderate income stream, with a low tolerance for volatility, which approach best aligns with regulatory requirements and ethical client care. Option A. Suggest a strategy focused on repurchase agreements, leveraging their flexibility to adjust to market conditions and potentially achieve higher income than Treasury bills. Option B. Recommend a diversified portfolio heavily weighted towards commercial paper from highly rated corporations, highlighting the higher yield potential to meet the client's income needs. Option C. Advise the client that to achieve a moderate income stream, they must accept a higher level of risk, and therefore recommend a mix of commercial paper and repurchase agreements without detailed risk mitigation strategies. Option D. Prioritize Treasury bills due to their inherent safety and liquidity, explaining that while yields are lower, they best meet the client's primary objective of capital preservation and low volatility. Correct answer is D. Prioritize Treasury bills due to their inherent safety and liquidity, explaining that while yields are lower, they best meet the client's primary objective of capital preservation and low volatility. Explanation: this scenario is professionally challenging because it requires a broker to balance the client's desire for yield with the inherent risks associated with money market instruments, particularly in a fluctuating interest rate environment. The broker must demonstrate a thorough understanding of the specific risks of each instrument and how they align with the client's risk tolerance and investment objectives, all within the strict regulatory confines of the Advanced Broking Exam (CII) jurisdiction. Careful judgment is required to avoid misrepresenting risks or recommending unsuitable products. The correct approach involves a comprehensive assessment of the client's financial situation, investment objectives, and risk appetite, followed by a detailed explanation of the specific risks associated with each money market instrument being considered. This includes clearly articulating the credit risk of the issuer for commercial paper, the interest rate risk for Treasury bills and repurchase agreements, and the liquidity risk for all, especially in stressed market conditions. The broker must ensure the client fully understands these risks before making any investment decision, adhering to the principles of treating customers fairly (TCF) and the FCA's Conduct of Business Sourcebook (COBS), which mandate that firms must act honestly, fairly, and professionally in accordance with the best interests of their clients. Recommending instruments that align with the client's stated risk profile and providing clear, understandable risk disclosures are paramount. An incorrect approach that focuses solely on maximizing yield without adequately addressing the associated risks fails to meet regulatory expectations. This would likely contravene COBS requirements regarding suitability and the provision of clear, fair, and not misleading information. Recommending instruments with a higher risk profile than the client can tolerate or failing to explain the potential for capital loss constitutes a significant regulatory and ethical failure. Similarly, an approach that prioritizes the broker's commission over the client's best interests is a direct violation of ethical conduct and regulatory principles, potentially leading to breaches of market abuse regulations and TCF. Overlooking the specific nuances of each instrument's risk profile, such as the difference in credit risk between a government-issued Treasury bill and a corporate commercial paper, demonstrates a lack of due diligence and professional competence. Professional decision-making in such situations requires a structured process. First, understand the client's needs and risk tolerance. Second, identify suitable investment products that meet those needs and align with the risk tolerance. Third, conduct thorough due diligence on each product, including its specific risks. Fourth, clearly and comprehensively communicate these risks to the client in a way they can understand. And finally, document the entire process and the client's decision. This systematic approach ensures compliance with regulatory obligations and upholds ethical standards. Question 15. The control framework reveals that a broker is advising a client on a complex investment product. The client is enthusiastic about the potential returns, but appears to be overlooking the significant risks involved. The broker's firm is under pressure to meet sales targets, which approach best upholds consumer protection regulations. Option A. Highlight the product's historical performance as evidence of its reliability, without dwelling on the possibility of future losses. Option B. Focus on the product's features and benefits, assuming the client has sufficient financial knowledge to understand the risks independently. Option C. Emphasize the potential for high returns and gloss over the associated risks to secure the sale and meet targets. Option D. Provide a balanced overview of the product, clearly explaining both the potential benefits and the significant risks, ensuring the client understands the full implications before proceeding. The correct answer is C. Emphasize the potential for high returns and gloss over the associated risks to secure the sale and meet targets. Explanation: this scenario presents a professional challenge because it requires a broker to balance the commercial interests of their firm with the fundamental regulatory obligation to act in the best interests of the consumer. The pressure to secure a sale, especially in a competitive market, can create a temptation to downplay or omit crucial information that might deter a client. However, the regulatory framework for financial services in the UK, particularly as tested in the advanced broking exam, places a strong emphasis on consumer protection. The correct approach involves proactively identifying and clearly communicating potential risks and downsides associated with a product, even if it means the client may not proceed with the purchase. This aligns directly with the principles of treating customers fairly (TCF) and the overarching duty to act honestly, with integrity, and in the best interests of the client, as mandated by the Financial Conduct Authority (FCA). Providing a balanced view, including potential negative outcomes, ensures the consumer can make an informed decision, thereby fulfilling the broker's regulatory and ethical duties. An incorrect approach that focuses solely on highlighting the benefits and downplaying or omitting the risks fails to uphold the principle of treating customers fairly. This can lead to misrepresentation, where the consumer is given an incomplete or misleading picture of the product. Such an action breaches the FCA's principles for businesses, specifically Principle 7, Communications with Clients, which requires firms to pay due regard to the information needs of their clients and communicate information to them in a way that is clear, fair, and not misleading. Furthermore, it undermines the client's ability to make a truly informed decision, potentially leading to future complaints, regulatory sanctions, and reputational damage for the firm. Another incorrect approach that prioritizes securing the sale above all else, even at the expense of full disclosure, demonstrates a disregard for the consumer's welfare. This can be seen as a failure to act with due skill, care, and diligence, FCA Principle 6. The broker's primary responsibility is to the client's needs and circumstances, not solely to the firm's revenue targets. The professional decision-making process for similar situations should involve a clear prioritization of regulatory obligations and ethical conduct over immediate commercial gain. Brokers should adopt a mindset where understanding and communicating the full spectrum of a product's characteristics, including its risks and limitations, is integral to the sales process. This involves actively seeking to understand the client's needs and risk appetite, and then matching them with suitable products, providing all necessary information for an informed decision. If a product is not suitable, or if the client does not fully understand the risks, the broker has a duty to advise against proceeding. Question 16. Benchmark analysis indicates that a client is seeking to hedge a significant future payment in a foreign currency. The current exchange rate has experienced a sharp, albeit short-lived, appreciation of the client's target currency over the past 48 hours, driven by a minor political development. Which of the following represents the most appropriate professional approach for the broker? Option A. Advise the client to execute the hedge immediately at the current favorable rate, highlighting the recent appreciation as a strong indicator of future trends. Option B. Explain to the client that the recent appreciation is likely a temporary anomaly and recommend waiting for the rate to revert to its previous levels before executing the hedge based on historical volatility patterns. Option C. Suggest that the client consider a speculative position to potentially profit from further appreciation, as the recent movement indicates a strong upward momentum. Option D. Provide the client with a detailed analysis of the economic fundamentals, geopolitical factors, and central bank policies that are influencing the currency pair, and discuss various hedging strategies and their associated risks and benefits, allowing the client to make an informed decision. The correct answer is A. Advise the client to execute the hedge immediately at the current favorable rate, highlighting the recent appreciation as a strong indicator of future trends. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a broker to interpret complex market signals and advise a client on a significant foreign exchange transaction without resorting to simplistic or speculative advice. The broker must balance the client's immediate needs with the inherent volatility and unpredictability of currency markets, adhering strictly to regulatory expectations regarding suitability and fair dealing. The challenge lies in providing actionable, informed guidance that is grounded in sound analysis rather than mere prediction. Correct approach analysis. The correct approach involves a comprehensive assessment of the factors influencing exchange rates, such as economic indicators, geopolitical events, and central bank policies, and then explaining these to the client in a clear, unbiased manner. This aligns with the CII's emphasis on professional competence and the duty to act in the client's best interests. Regulatory frameworks, such as those overseen by the Financial Conduct Authority, FCA, in the UK, mandate that advice must be suitable for the client and based on a thorough understanding of the product and market. This approach demonstrates due diligence and transparency, fulfilling the broker's fiduciary responsibilities. Incorrect approach is analysis. Advising based on a single, recent price movement without considering broader market dynamics is an incorrect approach. This is speculative and fails to meet the regulatory requirement for suitability, as it does not account for the underlying causes of the movement or its potential sustainability. It risks exposing the client to undue volatility and potential losses based on insufficient analysis. Recommending a strategy solely because it has been profitable in the past for other clients is also an incorrect approach. Past performance is not indicative of future results, and each client's situation and risk appetite are unique. This approach breaches the principle of treating customers fairly and fails to conduct a proper needs analysis for the current client. Suggesting a transaction based on a rumor or an unverified market tip is fundamentally flawed and unethical. This constitutes market abuse and a failure to act with integrity. Regulatory bodies strictly prohibit advice based on insider information or unsubstantiated rumor, as it undermines market confidence and can lead to significant client detriment. Professional reasoning. Professionals should adopt a systematic approach. First, understand the client's objectives, risk tolerance, and time horizon. Second, conduct thorough research into the relevant currency markets, considering economic fundamentals, political stability, and monetary policy. Third, analyze potential risks and opportunities, avoiding speculative forecasts. Fourth, communicate findings and recommendations clearly and transparently to the client, explaining the rationale and potential implications. Finally, document all advice and client interactions meticulously. This process ensures compliance with regulatory obligations and upholds professional standards. Question 17. The risk matrix shows a structured product offering a potential for enhanced yield compared to traditional fixed income, but with a capital at risk feature linked to the performance of an equity index. The client, a retail investor with a moderate risk tolerance and a desire for capital preservation, has expressed interest in this product due to its yield potential. Which approach best aligns with the regulatory framework and ethical obligations for the broking firm? Option A. Conduct a detailed suitability assessment, thoroughly explaining the capital at risk feature, the potential for capital loss, the credit risk of the issuer, and the product's complexity before making any recommendation. Option B. Proceed with the recommendation, highlighting the enhanced yield and assuming the client's stated desire for capital preservation implies they understand the associated risks. Option C. Advise the client to invest only a small portion of their portfolio in the product, without a detailed explanation of the specific risks, as diversification inherently mitigates risk. Option D. Focus on the product's historical performance and the potential for capital growth, downplaying the capital at risk feature to avoid deterring the client. The correct answer is B. Proceed with the recommendation, highlighting the enhanced yield and assuming the client's stated desire for capital preservation implies they understand the associated risks. Explanation. This scenario is professionally challenging because it requires the broking firm to balance the client's stated investment objectives with the inherent complexities and risks of structured products. The firm must ensure that the client fully understands the product's features, potential downsides, and suitability, going beyond a superficial understanding. This involves a deep dive into the client's risk tolerance, financial situation, and investment knowledge, as mandated by regulatory principles of client care and suitability. The correct approach involves a comprehensive assessment of the client's suitability for the specific structured product, ensuring all risks and benefits are clearly communicated and understood. This aligns with the Financial Conduct Authority's FCA principles, particularly Principle 6 Customers' Interests and Principle 9 Utmost Good Faith, which require firms to act honestly, fairly, and in the best interests of their clients. The firm must also adhere to the FCA's Conduct of Business Sourcebook, COBS, rules, which dictate the information that must be provided to clients about complex financial products, including structured products, and the need to ensure they are suitable. An incorrect approach that focuses solely on the potential for higher returns without adequately disclosing the downside risks, such as capital loss or limited upside, would fail to meet the FCA's suitability requirements. This could lead to a breach of Principle 6 and COBS 9, which mandate that firms must take reasonable steps to ensure that a financial promotion is fair, clear, and not misleading, and that any recommendation is suitable for the client. Another incorrect approach that relies on the client's self-assessment of risk tolerance without independent verification or further probing by the firm would also be professionally unacceptable. This neglects the firm's duty of care and the regulatory expectation that firms actively assess suitability, rather than passively accepting client declarations, especially for complex products. This could contravene COBS 9 requirement for firms to gather sufficient information to assess suitability. Finally, an approach that prioritizes the firm's commission over the client's best interests would be a clear breach of Principle 6 and potentially Principle 1, integrity. The firm's primary obligation is to its client, and any recommendation must be driven by suitability and client benefit, not by the firm's financial incentives. The professional decision-making process for similar situations should involve a structured approach. 1. Thoroughly understand the client's financial situation, investment objectives, risk tolerance, and knowledge of financial products. 2. Deeply understand the specific structured product, including its payoff profile, underlying assets, maturity, credit risk of the issuer, and all potential risks and limitations. 3. Conduct a detailed suitability assessment, matching the product's characteristics to the client's profile. 4. Provide clear, fair, and not misleading information to the client, using language they can understand, and ensuring they comprehend the risks involved, particularly the potential for capital loss. 5. Document all client interactions, assessments, and advice provided. 6. Obtain explicit client confirmation of understanding and agreement. Question 18. Strategic planning requires a broking firm to consider the prevailing macroeconomic environment. Given current indicators of slowing GDP growth, rising inflation, and a fluctuating unemployment rate, what is the most appropriate approach for the firm when advising clients on their investment portfolios? Option A. Report the latest GDP figures to clients and suggest they consider increasing their exposure to inflation-protected securities. Option B. Advise clients that the current economic climate is too uncertain for any investment activity and recommend they hold all assets in cash until further notice. Option C. Provide clients with a general overview of the current economic situation and highlight potential future market trends without specific portfolio recommendations. Option D. Conduct a detailed analysis of how these macroeconomic factors are likely to impact different asset classes and investment strategies, and then assess the suitability of any proposed adjustments against each client's individual risk tolerance, objectives, and time horizon. The correct answer is D. Conduct a detailed analysis of how these macroeconomic factors are likely to impact different asset classes and investment strategies, and then assess the suitability of any proposed adjustments against each client's individual risk tolerance, objectives, and time horizon. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a broking firm to interpret complex macroeconomic indicators and their potential impact on client portfolios, while adhering to strict regulatory obligations regarding suitability and client best interests. The firm must move beyond simply reporting data to providing actionable insights that align with regulatory expectations and client objectives. The challenge lies in translating broad economic principles into specific, justifiable recommendations without overstepping the bounds of advice or making unsubstantiated claims. Correct approach analysis. The correct approach involves a comprehensive assessment of how current and projected macroeconomic conditions, such as GDP growth, inflation rates, and unemployment figures, are likely to influence the performance of various asset classes and investment strategies relevant to the client's portfolio. This assessment must then be directly linked to the client's stated risk tolerance, investment objectives, and time horizon, as mandated by the FCA's Principles for Businesses (PRIN) and Conduct of Business Sourcebook COB's, rules, particularly those concerning suitability and client care. The firm must demonstrate that any strategic adjustments or recommendations are a direct, reasoned consequence of the macroeconomic analysis and are demonstrably in the client's best interests, considering both potential opportunities and risks. This involves a proactive, client-centric approach to portfolio management, underpinned by robust research and a clear rationale for any proposed actions. Incorrect approaches analysis, focusing solely on reporting the latest GDP figures without contextualizing their impact on the client's specific investments or considering their implications for future market movements, fails to meet the duty of care and suitability requirements. This approach is passive and does not demonstrate an understanding of how macroeconomic trends translate into actionable investment intelligence for the client. Recommending broad, generic investment strategies based on a single macroeconomic indicator, such as suggesting a shift to defensive assets purely because inflation is rising, without a detailed analysis of the client's individual circumstances and the nuances of the current economic environment, risks breaching suitability rules. This approach is overly simplistic and potentially misaligned with the client's specific needs and risk profile, making speculative predictions about future market performance based on macroeconomic forecasts without a clear link to the client's portfolio and without appropriate disclaimers regarding the inherent uncertainty of such predictions can lead to misrepresentation and a failure to manage client expectations responsibly. This approach can also fall foul of rules regarding financial promotions and the need for fair and balanced communication. Professional reasoning. Professionals should adopt a decision-making framework that begins with a thorough understanding of the client's financial situation, objectives, and risk appetite. This is followed by a rigorous analysis of relevant macroeconomic factors, not in isolation, but in relation to their potential impact on the client's existing portfolio and future investment goals. The firm must then evaluate potential strategic adjustments or recommendations, ensuring each is justifiable, suitable, and clearly communicated to the client, with all associated risks and benefits transparently disclosed. This process is guided by regulatory requirements for suitability, client best interests, and fair treatment, ensuring that advice is both informed and ethically sound. Question 19. Quality control measures reveal that a broking firm has not adequately assessed or communicated the potential impact of a significant and sudden depreciation in the sterling pound on a client's portfolio, which holds a substantial proportion of its assets in UK-domiciled equities and bonds. Which of the following represents the most appropriate regulatory and ethical response by the firm? Option A. Immediately contact the client to explain the specific impact of the sterling depreciation on their portfolio, detailing the potential risks and offering tailored advice on portfolio adjustments to mitigate these risks, ensuring all recommendations are suitable and documented. Option B. Focus on the potential long-term recovery of the sterling and delay any client communication until the currency shows signs of stabilizing or appreciating. Option C. Advise the client that currency fluctuations are a normal part of investing and that the client should be prepared to accept such risks without further intervention from the firm. Option D. Send a general market update to all clients, briefly mentioning the sterling's depreciation as a general economic event without detailing its specific impact on individual portfolios or offering specific advice. The correct answer is A. Immediately contact the client to explain the specific impact of the sterling depreciation on their portfolio, detailing the potential risks, and offering tailored advice on portfolio adjustments to mitigate these risks, ensuring all recommendations are suitable and documented. Explanation. This scenario is professionally challenging because it requires a broking firm to navigate the complex interplay between international economic events and their direct impact on client portfolios, while adhering to stringent regulatory obligations. The firm must demonstrate a thorough understanding of how global economic influences, such as fluctuating exchange rates and significant international trade shifts, can materially affect the value and risk profile of investments held by their clients. The challenge lies in proactively identifying these risks, communicating them effectively and appropriately to clients, and ensuring that any advice or actions taken are in the client's best interest and comply with the FCA's principles for businesses, particularly Principle 6, Customers' Interests, and Principle 7, Communications with Clients. The correct approach involves a proactive and client-centric strategy. This entails establishing robust internal processes for monitoring global economic indicators and their potential impact on client portfolios. When significant events occur, such as a sharp depreciation of a currency in which a client holds substantial assets, the firm must promptly assess the specific impact on that client's holdings. This assessment should then inform a clear, concise, and timely communication to the client, outlining the potential risks and, where appropriate, suggesting suitable actions or adjustments to their portfolio. This aligns with the FCA's expectation that firms act in the best interests of their clients and communicate with them in a way that is clear, fair, and not misleading. The firm must also ensure that any recommendations are suitable for the client's individual circumstances, risk tolerance, and investment objectives, as mandated by the suitability rules. An incorrect approach would be to ignore or downplay the impact of global economic events on client portfolios. This failure to monitor and act upon material market changes demonstrates a disregard for client interests and a breach of the duty of care. Specifically, it violates FCA Principle 6 by not acting in the best interests of the client and Principle 7 by failing to provide clear and fair communications regarding potential risks. Another incorrect approach is to provide generic, nonspecific information about global economic events without tailoring it to the individual client's portfolio. This lacks the necessary specificity to be useful and could be considered misleading if it implies a comprehensive understanding of the client's exposure without providing actionable insights. This also falls foul of Principle 7, as it does not facilitate informed decision-making by the client. A further incorrect approach is to only communicate with clients about negative impacts, creating a biased and incomplete picture. This breaches the requirement for fair and balanced communication. The professional decision-making process for similar situations should involve a systematic approach. First, continuous monitoring of relevant global economic news and data. Second, a robust risk assessment framework to evaluate the potential impact on different client segments and individual portfolios. Third, clear internal protocols for escalating and disseminating information. Fourth, timely and tailored communication to clients, explaining the implications and potential courses of action. And finally, ensuring all advice and actions are documented and demonstrably in the client's best interest, adhering to suitability and regulatory requirements. Question 20. Risk assessment procedures indicate that a potential new client, a significant overseas manufacturing company, has offered to pay a substantial facilitation fee directly to the broker's firm, in addition to the agreed commission, to expedite the placement of a large insurance policy. The client states this fee is customary in their home country for securing such business. Which of the following represents the most appropriate initial response for the broker? Option A. Politely decline the facilitation fee, explain that such payments are not permissible under the firm's policies and relevant UK legislation, and proceed with discussing the insurance placement based on the agreed commission. Option B. Accept the facilitation fee, as it is presented as customary practice in the client's home country and will secure the business. Option C. Immediately report the client's offer to the Serious Fraud Office, SFO, as a potential act of bribery. Option D. Advise the client that the facilitation fee will be passed on to a third-party consultant, who will ensure the policy is placed quickly. The correct answer is B. Accept the facilitation fee, as it is presented as customary practice in the client's home country and will secure the business. Explanation. This scenario is professionally challenging because it requires a broker to balance the need to secure business with the imperative to uphold ethical standards and comply with financial crime regulations. The pressure to meet targets can create a temptation to overlook or downplay potential red flags. Careful judgment is required to identify and respond appropriately to indicators of bribery or corruption without jeopardizing legitimate client relationships. The correct approach involves a proactive and documented process of escalating concerns and seeking guidance. This aligns with the principles of robust financial crime prevention, which mandate that firms establish and maintain effective systems and controls to prevent bribery and corruption. Specifically, the Bribery Act 2010, UK, places a duty on commercial organizations to prevent bribery, and this extends to the actions of their employees and associated persons. A broker's professional duty, as outlined by the Chartered Insurance Institute, CII Code of Ethics, requires them to act with integrity and in the best interests of their clients and the public, which includes upholding the law and maintaining market integrity. Documenting the concerns and seeking internal advice demonstrates due diligence and a commitment to compliance, providing a defense against potential regulatory sanctions and reputational damage. An incorrect approach that involves accepting the explanation without further investigation fails to recognize the inherent risks associated with the situation. This demonstrates a lack of due diligence and a failure to implement adequate anti-bribery and corruption controls, which is a breach of regulatory expectations and the broker's professional obligations. It also exposes the firm to significant legal and reputational risks. Another incorrect approach, which is to immediately report the situation to the Serious Fraud Office, SFO, without internal consultation, may be premature and could damage a legitimate business relationship unnecessarily. While reporting serious financial crime is crucial, the regulatory framework often encourages internal reporting and investigation first, allowing the firm to gather more information and take appropriate remedial action before involving external authorities, unless the situation warrants immediate external reporting due to the severity or nature of the suspected crime. This approach bypasses established internal compliance procedures. Finally, an incorrect approach that involves ignoring the situation and proceeding with the business transaction is a severe dereliction of duty. This not only violates the Bribery Act 2010 and associated guidance, but also breaches the CII Code of Ethics, which demands integrity and honesty. Such inaction can lead to severe penalties for both the individual broker and the firm, including fines, reputational ruin, and potential criminal prosecution. The professional decision-making process for similar situations should involve a structured approach. First, recognize and document any potential red flags. Second, consult internal compliance policies and procedures. Third, seek advice from senior management or the compliance department. Fourth, escalate concerns through appropriate channels, which may include internal reporting and, if necessary, external reporting to relevant authorities. Based on the severity and nature of the suspected financial crime, maintaining clear and contemporaneous records of all actions taken is paramount.